All right, what's happening, guys? Welcome to another episode of Sensible Investing, the deepest stock market research channel on YouTube. My name is Jesse, and today we're going to be talking about an indicator that I love to use, which is one of my favorite indicators, which helps me decide when is the right time to sell a stock. Okay, and what I wanted to do is to start off this video by prefacing this by saying, look, there is no magic bullet or magic indicator, okay? So there's no such thing as this one universal indicator which helps you understand when to sell a stock. And a lot of the time, we have to use inference, right? Because we have to then interpret this information and really translate that to, well, what does this mean for the business, you know? What are their customers saying? What are some of the changes and trends and dynamics that we can interpret from this information, which perhaps maybe management aren't overtly saying, okay? So a lot of it is via inference and the covert message being communicated. So that's something that I really find useful when I use this indicator to help me decide, basically when is the right time to get out. Okay, guys, and what I'm talking about here is basically the leading versus the lagging indicator, all right? And what I love to use when I do my stock research, looking at companies, reading earnings calls, listening to earnings calls, I like to focus on leading indicators rather than lagging indicators, okay? And according to Wall Street Mojo, they have a very good definition of the difference between a leading and a lagging indicator. And it's very simple, right? So the leading indicator is an economic factor that tends to change before the economy starts to change, okay, and helps us determine the direction of the change. Now, you guys can say, well, this is economics. This has nothing to do with investing. And that's about as far from the truth as you can get, because investing in businesses and companies is all about economics, but we're not talking about the macro level, okay? This is investing on the micro level. So we're talking micro level economics. And what I mean by that is, their customers, their suppliers, their competitors, the industry itself. Again, this might seem quite big, but in the greater scheme of things, it's one of many thousands of industries and other players in the game, okay? So what I wanted to now take you through is the difference between leading and lagging indicators, okay? So if you look on the right-hand side of the page, lagging indicators are things that happen after something has happened, okay? So for example, if a company has sold X amount of, I don't know, milk, right? Or if they have given X amount of loans, then what you get is you get their numbers on their P&L, right? Their balance sheet, their profit and loss statement, and you can get ratios, okay? So we're talking, the price to earnings, the price to book, the price to sales, EV, EBITDA, whatever, right? But these are all indicators and things that happened after the fact. And what we want is we want things that happen before the fact, which then give us an understanding of the trajectory of what's likely to happen, okay? So what I mean by that is we're talking, non-GAAP metrics. We're talking microeconomical factors. We just discussed that before, right? We're talking industry change, industry trends, sorry, changing customer behavior, okay? A change in the way that management starts to report or speak about their results, okay? The language here is very important. And again, guys, inference. We have to use inference, okay? And what I'm going to take you through now, through the rest of the video, is, first of all, why leading indicators are the gold standard and lagging indicators are effectively useless, okay, guys? And I know some of you guys might be thinking, whoa, these PE/PB ratios, that's gospel. How can it be worthless, okay, guys? And what I'm going to do is I'm going to give you evidence throughout the rest of the video why that is the case. And guys, if you're enjoying my videos, but more importantly, you're getting value from the content, why not take a second to just hit the like button and subscribe button and leave a comment. It really helps me to bring you more and even better quality content. Okay, guys, so why are lagging indicators effectively useless for predicting the success and future trajectory of a business? Okay, guys, and what I wanted to do is I wanted to use 3 examples of companies where people were screaming were overvalued, okay, and they couldn't have screamed it any harder, and yet the businesses continue to do well and they will continue to do well, okay? And the companies that I wanted to give you some examples of were Salesforce.com, CSL, which is a big sort of biopharma tech company in Australia, and Afterpay, which I guess you can say it's kind of like the biggest darling in the Australian stock market. Anyhow, now these three companies, okay, so I won't go too deep into all of them, but let's take Salesforce.com, okay? So all the way from back in 2010, 2011, people have been going, oh, this is very, very overvalued, okay? So these guys were going to the Berkshire Hathaway annual meeting, and they're all sitting in a circle, right? And they're all saying, oh, this is overvalued because the PE ratio is 83, and then, you know, they've got no moat, and there's no price to book, and, you know, but what they weren't talking about was how things were changing in terms of how customers were trying to capture information about their customers, okay? How people would aggregate and collate information and use that to get insight and data about their customers, right? How the information that they get can actually track the usage behavior of their customers for an essential tool such as a CRM system, okay? And you know, they weren't talking about all of these things like, you know, total lifetime of a customer. When a customer signs up, what percentage of them leave versus what percentage of them stay, and how long do they stay for? How many extra modules do they buy throughout their lifetime? What customizations do they get on top of their initial CRM functionality? And then on top of that, how long do these customizations last before they need to re-customize again and spend more money, right, guys? So these are all of the things that are leading indicators, which they didn't talk about, right? And as a result, you know, you've got here overvalued, right? It's time to avoid these companies. PE ratio is too high. There's no free cash flow. All of that, right? And they've been saying this for years, and the companies have continued to do, you know, better and better and go on to record highs, okay, guys? And so this is why lagging indicators are useless, because it tells you nothing about the microeconomics or the actual business. All it tells you is some numbers on a piece of paper that they report every quarter and every year. Okay, guys, so now what I wanted to take you through is why leading indicators are far superior to lagging indicators. And if you really truly want to invest in a business, right, not a stock, in a business, then you'd be prudent to use leading indicators, all right? And so what I'm going to do is I'm going to use the company Abiomed, and I'm going to focus on the time between sort of, you know, mid-2018 to mid-2019, and I wanted to take you through some of the key indicators that I found, which coincides perfectly with the time that they started having a bit of volatility and the share price was very, very wobbly, right? And already when I see this, this tells me that there's a lot of people in the stock that don't know why they're in the stock. They kind of just bought it because of X, Y, and Z reason, but they know nothing about the economics or the business of this company. Okay, guys? And so what I wanted to take you through now is the topic of consistency. So I believe consistency is the most powerful leading indicator that you can use, okay? It's not the only leading indicator that you can use, because you have to use it in combination with a lot of other leading indicators to help you make an informed decision, but it is the most powerful one you can use, which is consistency. And what I mean by consistency is consistency in the way that management reports and in the language that they use and in the metrics that they report, okay, guys? So remember, okay, language, habits, metrics, okay? These are the best indicators of consistency. And guys, what I wanted to take you through now is into all of their non-GAAP financial metrics that they report, and I wanted to take you through how that has changed and evolved in the space of about 7 to 8 years worth of reporting, okay, guys? And I want you to look at the subtle cues and subtle changes, and then we're going to break down exactly why that's important. So what we're going to do is we're going to go into my spreadsheet and break that down metric by metric. All right, guys, welcome back. So as you guys can see, I've used thick borders to highlight the sections that I wanted us to focus on, okay, guys? So I'm just going to show you the areas that I wanted us to focus on and give you some quick context. So Abiomed, what they do is they make the impeller heart pump, okay? And their value proposition is that these heart pumps are revolutionary for increasing patient outcomes and reducing the cost of the system for anybody that has cardiogenic shock or heart attacks as a result of a failing left or right side of the heart or the whole heart. Okay, guys? So this is their value proposition. Now, they've got these core products where they've launched, and you had the Impella 2.5, then you had the CP, then you had the RP, then you had the 5.0, okay? So the products have evolved over time. And what they very much would focus on, and I couldn't go all the way back to 2013, and the reason being is because, you know, they didn't have the earnings calls transcripts. But what it did was I was able to go back to 2014, 2015, and focus on a couple of the key things, okay? And the key things that they report on, and this is very, very important, okay? We've got reorder revenue, i.e. the customers who reorder and how that's increasing or decreasing over time. Their reorder rate, okay? So are they likely to buy more or the same or more of what they bought in the subsequent years, okay? And then we have the change in reorder revenue, but also the actual patient utilization of their products, okay, guys? Because if people are buying things but they aren't using it, then that's a leading indicator that they may very well likely not find value and stop buying it. Now, let's focus on the first part, okay, guys? So let's focus on them breaking down, as you can see here, the number of sites that have their different products, okay? So they're different Impella models. And if we move along this spreadsheet, okay, guys, I'm going to move along slowly. You'll see that they have consistently reported the disaggregated units per hospital site, per product, until Q3 of 2019. And you'll see what happened was they've now merged the CP and 2.5 Impella model into one number, okay? So very, very subtle, guys. And then the very next quarter, they then disaggregated it and started to report them separately. Now, no analyst asked the question on the call, why did you do that, okay? I've read all their calls, nothing, okay? They didn't ask, why did you bring it back the next quarter? But more importantly, they didn't ask, well, in your most recent quarter, why did you stop disaggregating all of your different Impella products and just started reporting them together, i.e. the CP 2.5 and the 5.0 and the 5.5, okay, guys? So this is a very, very subtle cue and a subtle detail. And if you actually read management's language, which I'll show you later, it's very, very interesting. Okay, now, guys, let's go back down here to 2015, okay? And we're going to focus on the reorder rate, okay, the change in reorder revenue, the actual value of the reorder revenue, okay, and then the utilization. And if we look, you can see they've consistently reported it until, again, first quarter and second quarter 2019 it starts, okay, guys? And you can see the reorder revenue has significantly increased until boom, right? First quarter 2019, right? We're talking sort of 10, 15, 20% growth, and then all of a sudden, it can't even meet a 3% growth in reorder revenue, okay, guys? But what's more importantly is if you actually look at the change in reorder revenue, they stopped reporting this number altogether. Now, going on to the next quarter, they've actually stopped reporting reorder revenue growth. And if I highlight it over here, you can see, look, they've actually stopped reporting just a reorder number, right? Altogether. And they've stopped reporting the revenue growth, okay, guys? So again, we have to use inference. Why is that the case, all right? And as you can see, it's very interesting, right? So this perfectly coincides with a time when their share price was starting to get very volatile and very wobbly, and subsequently the thing crashed, okay? And the time from when it started getting wobbly to when it absolutely crashed, the timing, the gap in time, okay? The time gap was about 9 months, which, as you guys can remember from the beginning of the video, I told you, leading indicators indicate the direction of something that's going to happen at some point in the future, okay, guys? And as you can see, when they started being very evasive with their reporting, you know, we can infer that something has happened within the business, and most likely something negative. Now, obviously, management didn't explicitly say that, but we have to ask the question, why did they not break down the sites? Did one of the sites maybe go backwards by a lot, right? Why did they not break down the reorder revenue? Did the reorder revenue all of a sudden just tank, which is what's causing them to miss their numbers? Okay, so these are all questions we have to ask, and we have to use inference. Now, I wanted to take you guys through some extracts of their earnings calls, okay? And I want you guys to look at the language for a second and really just have a look at what the difference is, okay? Very subtle differences, and that's what I talk about when I say consistency, all right? See if you can spot the inconsistencies, okay? So take a second. All right, now, in the interest of time, guys, and for the video not to get extra long, I'm just going to highlight it for you, okay, guys? So we have to play Where's Waldo over here. Look at that, right? Reorders increased 35% to 140 million. The next call, they didn't say the percentage, they just said the number, right? And then the very next call, there was nothing altogether, okay, guys? So now you could, it's very hard to spot this if you sort of read it quarter and quarter because you forget, right? But if you put it side by side, okay, and here's a really funny little image towards the bottom of the right-hand side, okay? Subtle differences, okay? And the lack of consistency will give us a very good indicator that something's wrong with the business, okay? So you look on the left, okay, my roommate was browsing his computer just normally, but then if the mouse goes to the left-hand side, then you know he's been on Pornhub, okay, guys? So very funny little meme there, but look, this is why consistency is so important. Okay, guys, and just a little bit more illustration in terms of consistency, okay? As you can see, they broke down their sites, okay, their products per site. Then the very next quarter, they didn't break it down, and then they go back to breaking it down, okay, guys? Very, very fishy stuff. And management will do all these little quirks to try and just sort of get away with, you know, I guess lessening the problem or ensuring the market doesn't panic. And they'll try and fix things in the background, right? Rather than be upfront and tell you what's going on, they'll try and fix it in the background until the very last minute it's too late. And then they go, oh, our EPS is going down or our revenue number missed, okay? But by that time, it's already too late. The PE ratio doesn't tell you anything, okay? And that's why lagging indicators are useless and leading indicators are the indicators that you want to be using when you do your stock research. Alright guys, and here's another thing that I actually discovered very recently, which is called the days in inventory outstanding, okay guys? And I really enjoy using this indicator, and I really enjoy looking at a change in how things are happening, right? Because look, the days in inventory outstanding, it basically tells us how quickly their customers are taking the inventory off their hands, okay? And you know, how quickly they're able to clear it, right? Because if inventory stays in the channel for too long, then obviously there's something wrong, right? Because if people aren't buying the stuff and it's taking them long to clear, why is that, okay? And again, we have to use inference and ask ourselves the question. And now, it's very, very good if you analyze any company with products that they sell, okay? Services, not so much. But if they have a product, okay, and if they have a channel, right, we're talking, you know, look at all the companies out there, right? You got Ulta Beauty, you've got A2 Milk, you got anybody that has a channel and a product, have a look at the days in inventory and see if anything's fishy. And you guys, again, will see towards sort of Q1 2019, Q2, a massive rise in terms of the days in inventory outstanding, all right? Just look at that, right? Already this tells me something's wrong. And, you know, okay, 3 quarters later, everything starts to become unraveled, and then the stock price tanks, and then management have said, look, we've got all these potential issues, but they've sort of, again, tried to make an excuse and blame something else, okay, guys? But again, we have to use inference. Okay, guys, and so we're nearing the end of our video, so what I just wanted to take you through are some other examples of very good leading indicators that you may want to use, and so just remember, these aren't the examples of, you know, these aren't set in concrete, okay? So this is not gospel. There are lots of different leading indicators that you have to find, and investing is much more an art than a science because there's a lot of inference and covert sort of messaging that we have to interpret, okay, guys? So, for example, I'm researching Ulta Beauty at the moment. Now, because I'm researching Ulta Beauty, the last thing that I'm going to look at is their balance sheet, okay? I don't care about the PE ratio. I don't care about the EV, but that cash flow. I don't care about any of that, okay? What I want to know is, what are their customers saying? Where are they saying it? Who their customers are comparing it to, right? And what's the trend, right? What products do they love? What don't they love? Are management responding to these trends, okay, guys? And the only way that we can find that out is on things that show us leading indicators, okay? We're talking YouTube, Twitter, Instagram, whatever, okay, guys, Reddit, okay, guys? And as you can see, it has nothing to do with the numbers or the ratios or anything. Right, I'll give you another example, okay? Afterpay. This is my, by far, biggest position in terms of my Australian portfolio, okay, guys? And I'm up, 42% on the stock almost, okay? And when I bought the stock, again, people were saying, oh, this company makes no profit, it's raising capital, there's no, it's all of the same arguments that they used when they were trying to short or dismiss Salesforce.com when it was at, whatever, like $30, and now it's $180, okay, guys? And the reason being is because, again, I use leading indicators to help me make my investment decisions, okay? So if I want to look at a company like Afterpay, I will be looking at all of these things, all right? I want to be looking at the trends. I want to be looking at the shopper behavior. I want to look at how the app is trending over time. I want to look at their Instagram likes. I want to look at what their customers are talking about, but more importantly, who they are talking about Afterpay to, right? I want to look at the web traffic. I want to look at how people are coming to Afterpay's website. And after coming to Afterpay's website, where are they going? Okay, guys, these are all of the leading indicators. Right, guys, so that's the end of the video. So let me leave you with a very, very, very good comment from Warren Buffett over here, okay? I sit in my office and just read all day. So again, what does this mean, all right, guys? And again, we have to use inference to interpret that. And effectively, what that means is the best investors in the world are the best readers in the world, okay? But what I don't mean is just read the damn thing and just let it go like this, okay? Read it and use inference to interpret what it's truly saying, okay? Look beyond the message, and I think that's where you're going to find gold, okay, guys? So, guys, that wraps up a video. My favorite indicator to use to help me understand when is the right time to sell a stock and when is the right time to get out, okay, guys? So, hope you really enjoyed the video and you got some value out of this, and share the video if you know someone who will find it useful. Until next time, happy investing.